Good evening, everyone. I'm CA Manobhar Verma, and I will be your chauffeur for very important topics of financial management, starting with cost of capital, investment decisions, and towards the end, working capital management. I believe each and every one is doing good, is all busy and engraved in your preparation strategies towards your examinations. And I'm sure I will partner in your journey so that any challenges, any difficulties in understanding the concept will be resolved amongst all these lectures. So I'm very excited to join you all in your journey here. So welcome everyone once again. So guys, today's topic is the cost of capital. And I want to understand from all of you what all you have done till now in financial management is probably, the three important decisions of a financial manager. Let's see who can answer this one. I believe in a two-way traffic, I'm sure a lot of interaction will happen in all these sessions. So let's see who would like to answer this one. So what were the three important decisions of a financial manager, guys? So let's see, I'm just looking at some responses. Let's see who answers this first. Three important decisions, guys. Okay, so Nikita says investment decision. What about others? We have investment decision. Okay. Other decision, guys. Okay, now I can see a lot of responses. Akash Neil, investing, financing, dividend. Karthik also saying investing, financing, and distribution. Aditi also. So Aditi is talking about the objective, right? Aditi, you're talking about wealth management. That's an objective. So wealth management over the profit maximization. What I was talking about is the three important decisions. So I think very well said by everyone. I guess each and everyone has responded that with respect to the decision making. Now, why I am correlating this to these three important decisions, right? So one of these, rather, I would say from the journey perspective, we will cover each and every one. But yes, the one of these decisions which relates to the topic for the day is your financing decisions. So when we talk about cost of capital, we need to understand anyone who would like to start a business, any institution like to set up something, they need capital, right? And when they need capital, it would be coming from the providers. Would they provide capital without anything in return? Of course not. They have their expectations. So whenever we talk about cost of capital from business standpoint, guys, always understand it's actually with respect to the returns expected by the capital providers. Now, these providers can be shareholders. These providers can be the financial institutions, lenders. But the idea is that it is with respect to not what you are paying to them, is rather their expectation. And that's why we also sometimes refer to that as a hurdle rate or opportunity rate. I hope you understand when you talk about opportunity cost from an investor perspective, what they are considering that okay, they are contributing to your business and they're not investing somewhere else. And that's what flows down from expectations of the capital providers. Now, as a finance manager, what is your objective with respect to cost of capital? I hope, like someone said, wealth management here, right? So you have your objective, and how do you maximize your wealth? Is there something we can do in wealth maximization specifically with respect to cost of capital? Why not? See, we know that yes, that erstwhile, few decades back, profit maximization was something we were looking at, but now we understand wealth maximization is much broader term. But at the end of the day, when we talk about wealth, we need to understand it's like a jaw, right? On the upper jaw, you're talking about a profit. On the lower jaw, you're talking about the cost. So in terms of the your revenue, your profits, at which cost they are earned is what you would like to maximize. So it's very important that as a finance manager, you have to strike a good balance where you would actually want to achieve a minimum cost and maximize the wealth. And I'm sure each one is with me on this. But also, it's very imperative to understand that, yes, while we are studying cost of capital, there are certain areas where we will be using these these concepts again and again. As I said, there are certain topics I will be personally going through with you all guys, after cost of capital, investment decisions, working capital management, and we will be using the cost of capital in each of them. When we talk about investment decisions, we'll be using the cost of capital. So in terms of the usefulness of the cost of capital, it's very important that we need to understand that yes, it is not only important for investment decisions here, but it will also be helping us for our short-term operations in respect of optimum credit policy. But yes, having said that, we need to understand the concept first. We need to talk about that how a finance manager can actually strive at something which could result in a lowest cost. Now, I think one more important thing we need to understand that yes, the capital may not be only coming in from one source. It may be coming in the form of share capital. It may be coming in the form of some kind of a lending arrangements, from the financial institutions or bonds or debentures. Now, that means based on the risk capacity and other factors, when an organization understands that, yes, my source of capital, source of funds, we talk about financing decisions are coming from different sources, I need to understand cost of capital of each of those sources. Only then I can arrive at something which would be a balanced or a least cost opportunity for us as an organization. I hope everyone with me on this. So let's talk about this, in terms of what all the sources of capital could be. So we have our equity capital, we have our preference shares, as I said, in terms of your equity. Then we are also talking about debt part in terms of the bonds or lending institutions or loans. One important aspect, though, we need to understand when we are talking about equity, it may be the fresh capital introduced, but it could be a reinvestment of the plot back earnings in the form of retained earnings here. So it's very important that we understand that even when we talk about expansion, even the retained earnings can carry a cost. Why so? Can anyone tell me why there could be a cost attached to a retained earnings? Let's see who answers this one. As I said, guys, I will be involving each and every one here. You need to be interacting with me, right? So we'll have all these sessions super interactive. So let's see why a retained earning can carry a cost. Everyone knows like what is a retained earning is like profit not distributed. Why it carries a cost with it? So let's see who answers this one. Second question of the evening from my side. Okay, just waiting for a few responses. Sudhanshu is asking what is return on investment. Sudhanshu, return on investment in terms of the investor, when they are, investing in your organization, in the business, they would be expecting something in return. That's return on investment. And from an organization perspective, right? So when we're talking about from both the entities, right? This is the business here. And these are the investors. So when we are talking about these guys putting in funds onto this business, they will be expecting some return, but their return would be a cost for us. Sudhanshu, I hope that helps. Okay, so response for my question though, why a retained earning could carry a cost. So Banreddy is responding that if invested out, we get returns. Okay, Siddhant says opportunity cost. Aditi says because it has to be reinvested in the company, so definitely it has to be a cost attached. Gehani says if it is not invested, we can face opportunity cost. Yes. Okay, so I think I'm glad most of you are talking about in terms of the opportunity cost, right? So probably everyone is on the same page. Even Purnima says retained earnings is when invested earns returns, but when distributed loses the opportunity opportunity. So it's a good way of looking at things, guys. And I think Hiral, I like your response. Hiral says cost of foregone by shareholders. So cost of benefits foregone by the shareholders, what you wanted to say. Alu says stakeholders are giving up their opportunity cost, and Smitha also adding that company invests that retain earnings of investors and pay half returns to the investors. That's company is a cost. So I think let me summarize what each and everyone said here. It's absolutely brilliant, guys. But yes, what each and everyone said that yes, okay, there are certain profits companies earning, and instead, like some part is distributed as a dividend, but the part which is not distributed is plowed back into the business, right? So that means that from an investor perspective, that could have also been distributed, but it is retained, and of course they would also want a return. So that is anything or rather nothing but addition to the capital contribution in terms of the equity itself. So we will be discussing some interesting concepts with respect to the return earnings, but yes, all of you are absolutely correct here. So that was amazing response, guys. So we will talk about each and every component cost here, and then once we understand that, it will be very important for us to know, okay, which would be the best combination, or I would say the least cost combination of various sources of capital. And then we will understand how we compute a weighted average cost here. Now, let us start our understanding from long-term debt. Now, when we talk about long-term debt, I'm sure you understand that, yes, we're talking about some financial institutions loans, or we are talking about bonds or debentures. Quickly, I would like to mention some terms which you should be familiar, and I think many of you might be already so when it comes to bonds or debentures, guys. So one is indenture or agreement, which specifies certain terms and conditions, specifically with respect to, let's say, a maturity period, which is like in terms of the duration or the coupon rate. Now, what is coupon rate? It's like what interest rate is committed by the business to pay these debenture holders. Right? That's an interest rate. That's a coupon rate, stated rate of interest rate. That would also be mentioned in the agreement. Then there is a face value that is mentioned for the bond. Now, what is this face value as? Face value is the legal value or par value for each debenture. Now, there could be a scenario that these could be issued at a premium or a discount, but that generally relates to the factors with respect to the interest which the company is paying, that is interest stated, versus the market rate of return. Now, those are the factors which could actually lead to a premium or discount. But at the end of the day, once we are talking about the debentures, we are talking about a long-term liability here. We are talking about a fixed maturity, and that means there has to be a value at which it will be paid off, and that is called as a redemption value. Now, very interesting aspect with respect to the long-term debt is that when you are paying interest to these holders, to these instrument holders, that interest is a deductible expense for the purposes of tax computation. So hence we call it as that, yes, you get a tax benefit for the interest paid here. Now, question from Hiral. Hiral, you asked me about the cost of retained earnings is related with cost of equity. Yes, Hiral, we'll talk about that eventually. Don't worry, we'll talk about that, how the cost of retained earnings will be related to equity itself, okay? Because they are part of the equity. You will see that, okay? So guys, coming back to long-term debt. So very important point here that the interest part is definitely tax deductible. And that's what sometimes, it makes, couple of reasons for which the debt or the bonds are actually an attractive sourcing of finance. A, that they're talking about the fixed interest, and B, that interest is tax deductible. Now, what is cost of long-term debt? Here we will be talking about categorizing the long-term debt with respect to couple of categories with respect to the redemption period, I would say. One is a irredeemable debentures and one is a redeemable debentures. Now, when we talk about irredeemable debentures, I hope you understand that these are like not redeemable during company's lifetime, although from a practical standpoint, you would more or less see the redeemable debentures, right? Not redeemable is something which is on the contrary. When we're talking about long-term liability, we would more or less associate ourselves with the redeemable in most of the present day companies. But yes, let us understand that, okay, if there are debentures which are not redeemable during the lifetime of the company, or if there are debentures which have a fixed maturity, let's say 5 years, 7 years, 10 years, first of all, we are talking about not redeemable here. Now, if you see the cost of debt here, okay, clarification from Aditi here, agreement also called as indenture. Yes, Aditi, right? Okay, so if the formula for cost of long-term debt, guys, you need to know these formulas. That is very much a requisite for solving all the cost of capital related questions. Okay, so cost of debt, let's talk about numerator here. Interest multiplied by 1 minus t. Okay, so if there is 100 rupees debenture and I'm talking about a 10% interest, I'm sure you understand the interest is 10 rupees. You might wonder that, hey, 10 is something which it should be my cost, but I'm saying 1 minus t here. Why I'm saying 1 minus t? As I explained you all in the previous slide, we're talking about the interest being tax deductible. Now, to explain this concept, let me briefly give you an idea. Give me just give me a second. So why we are looking at a 1 minus t concept here? Just give me a second. So in this case, guys, I am talking about two scenarios for us. Scenario A and scenario B. Let's say we have earning before interest and tax. In both the scenarios, we have earning before interest and tax as 1 lakh. And let's say in the scenario A, the entire capital is of share capital, or let's say equity. And there is no debentures. Whereas in the case of scenario B, you have a 5 lakhs of share capital and 5 lakhs of 8% debentures. Now, if I'm looking at EBIT, which is in terms of 1 lakh, a common scenario, that means after that, before I compute the tax, I will be talking about interest amount. Yes, I believe everyone understand that there will be zero interest here because there are no debentures in terms of the cost of cap, in terms of the capital structure we have chosen here. In the scenario B, however, there what will be my profit before tax? This will be 1 lakhs. And this is your 60,000. Let's say my tax is 20%. Let's assume that. So 20,000 and this 20% will be a 12,000. So my profit after tax is 80 and 48. Is everyone with me on this till now? I hope you guys are understanding what I'm doing here. We're just talking about two different examples. And I just want you to realize that why we are doing 1 minus t over there. Now, all eyes on this tax component. Guys, as I added a debt component to my capital structure, my tax got reduced from 20 to 12,000, guys. 20 to 12. Why did that happen? And this happened because of this interest element, which actually reduced my profit before tax. Now, that means if I have to evaluate what is my real cost, what is my real cost of debt? Is it 40,000? That's what my question is. Is the interest element of 40,000 is my real cost? When I think very deeply, I also realize that there are saving in tax of 8,000. That means the net cost is a 32 here. So guys, that means we are talking about interest into 1 minus t in that formula, and hence we are looking at 40,000. 1 minus 0.2 equal to 32,000. So I hope the clarity on tax saving component is with everyone. So this would help you to not only understand this, but I'm sure all the earlier formulas you learned in financial ratios and other aspects will be really, really helpful for this one. Coming back, guys. So numerator is sorted. I into 1 minus t. I want to focus on the denominator. It says net proceeds. Now in net proceeds, there could be a scenario that, okay, the company is going for a new issue of debt. Then we are using net proceeds. And in that case, the net proceeds would be net of any, flotation cost. Whereas if it is an existing debt, and let's say you want to evaluate some kind of an investment opportunity, we will be doing that in investment decisions, by the way. And let's say this is an existing debt and we want to evaluate some investment opportunities. So in that case, if it is an existing debt and I want to calculate my cost of capital, in this case, we will be using the current market price and not net proceeds. So always remember, if it's existing debt, use the current market price. And if it's a new debt or a new issue, always use net proceeds. Guys, I hope this is clear to everyone. Okay, so Pooja has a very valid point. Pooja says, but sir, we have to pay 40 plus 12, 52. Whereas a non-borrowing company has an expenditure of only 20,000. Pooja, that's amazing way. I would actually like to thank you to bring it your clarification or your query in that way. So Pooja, when you are saying to me that yes, in scenario A, the total expenditure was 20. In scenario B, the total expenditure is 52. That is exactly what I'm trying to say. So the cost of debt is what? Incremental, 32. Pooja, I hope that is clear. I think your question itself had an answer. Right. So the debt had that additional cost over there. But that was not 40 now. That's not 40. Interestingly, the effective cost is only 32 because of the tax savings. Yeah. I hope that's sorted. But thanks for asking that question. So guys, I would encourage you guys, even if you have any kind of an iota of doubt, just clarify there itself. Trust me, students sometimes hesitate to ask queries, thinking that, okay, should I ask it? Should I not ask it? Oh, is it a silly doubt or whatever? Guys, no question is a silly question. It's like you need a clarification. Trust me, out of all the years of experience, what I've realized that when students ask doubts without hesitation, the others actually thank them. Like, thankfully, he or she asked, because they were also hesitating. But anyways, thanks, Pooja. I hope that is clear now. Yeah. Okay, so guys, let's quickly talk about this illustration on the right hand side. 5 years ago, Chandi Limited issued 12% irredeemable debentures at 103 at 3 premium to their par value of rupees 100. Current market price of these debentures is 95, and if the company pays corporate tax at 35%, calculate its current cost of debenture. Guys, can you guys give me a quick answer for this in 1 minute? Let's see who answers this. So the current market price is 95, 12% is the interest rate, and the tax rate is given to us 35%. I hope everyone understands that this is not the case of a new debt. Okay, I think a couple of Durga, you're saying that the illustration is not clearly visible. Guys, I hope everyone can see the screen though. I'm repeating the facts for you guys in case there is any issue. We are talking about 12% irredeemable debentures. 12%. I'm repeating again. They were issued at 103, but the current market price is 95 and the tax rate is 35%. So you have to calculate its current cost of debenture. Okay, like I'm getting many students giving an answer of 8.21%. So Dhanshu, you're talking about 8.84. Okay, so as I can see, majority of you are giving me an answer of 8.21. I think couple of deviations, but guys just need to check. We are talking about existing debt here because 5 years ago, mind you. So we are talking about existing. And when we are talking about existing debt, 12% is my interest rate. So 12 into 1 minus T. Tax rate was 35%. And here the net proceeds would be the current market price. So all those who gave 8.21% are absolutely correct. And anyone who was slightly here and there, I hope you understood where you went wrong. Okay, so I can see many answers. Sarthak, Gihani, Khushi, Sudhanshu, Smitha, Siddhant, I think Tanvi. So good job, guys. I thought so. All answers amazing, guys. I'm sure just one or two answers were slightly deviating. I'm sure you guys know where you went wrong. So now let's talk about. Okay, Karthik says concept is not so clear. Karthik, again, the numerator part is clear. I'm sure 1 minus T. The denominator part is with respect to the existing or the new debt. Here the term requirement was 5 years ago, right? We're talking about 5 years ago. It's an existing debt. And in terms of existing debt, there will not be any flotation, any issuance cost. And if there are not any issuance costs, so you're not going to take net proceeds, right? So the idea is if I'm talking about the existing debt, I take the market value at what price a similar debenture or similar debt security is trading at. And that's what it is. In case it was a new issue though, we would have taken the net proceeds. Okay, so Hiral says, why is not calculated 103? Okay, Hiral, that's a good question. Hiral, we are talking about when we calculate the interest rate, or I would say interest payments, we always calculate this in your par value or face value multiplied by your stated or the coupon rate. We always do that. the premium amount or the discount is actually with respect to the differences between the market rate of interest at that point and our own interest offered. So generally, so this is just for your knowledge, guys. I can tell you that if a company is issuing a premium, probably the reason is that they are offering a slightly higher rate of interest than the market. If they are issuing it at a discount, their interest rate is slightly lesser than market, guys. Hiral, I hope that is okay. So Dhanshu, that's perfectly fine. Okay, sir. So I hope everyone is clear now. Just quickly checking any queries unanswered. Yes, Mitha, 1 minus T is what we discussed about the tax savings of the interest. The example I explained a few minutes back. Yeah. So Karthik says basically this 8.21 is if we raise 95 from the market. Yes, absolutely. Absolutely. So that's based on the current cost because it's an existing debt. It's an existing debt. So what is the cost as of today, right? But we actually go for the new issue. Then we're talking about the net proceeds because Karthik, in that case, your flotation cost also comes into the picture. Then the flotation cost also play their role, and that's why the net proceeds can be different. Okay, so now we move to the cost of redeemable debentures. When we talk about cost of redeemable debentures, and these are like more common, where we talk about in terms of the long-term liability, that these can be redeemed at a specific maturity date. And not only that, they can be redeemed even on an earlier date. Now, for these, debentures, formula is slightly different. Now, I will make you understand the logic behind the same. Let's take it part by part. Now, the cost of debt in this case, you can see the formula looking slightly, I would say, expanded, but there is a reason behind this. We are talking about I into 1 minus T. So that logic remains the same. That logic remains the same. That is, interest is tax deductible here. So this is taken care of already by us. But now we are saying plus redemption value minus net proceeds upon N. What is that? Redemption value is at the price at which these debentures will be paid. That's the redemption value. I explained you in the basic terminology. And net proceeds, depending on whether we are talking about new debenture or existing debenture, it could be the net proceeds issuance minus the flotation cost or the current market price. That means we all understand that redemption price could be more or less. Redemption price could be more or less. And if it is more or less, would result in a kind of a profit or loss situation for the company, guys? Yes or no? If they're redeeming for a higher price, they're paying them back more, it's not so good. It's a loss situation. But if they are redeeming their debentures for a lesser price than they actually received, so that means that is actually a good position for the company. Now, what we are doing here is we are deferring it. We are spreading that difference over the term of the debenture, guys. Over the term. And if we are talking about, existing cost, or at some specific point of time, we are calculating the existing cost of debentures, we are talking about the remaining life of debentures. So if you are talking about initially, it will be the entire life. But if you are actually seeing the existing debentures, it could be remaining life. So what we are saying is we are deferring that spread across the life of the debentures, guys. I hope everyone understands RV minus NP upon N. So that means the cost is basically interest, of course, interest 1 minus T, plus minus the difference between the net proceeds and redemption value. I'm talking about this overall, across the entire life of the debenture. But that difference is actually spread over the remaining life. And that's why we are calculating the cost, incorporating the same. So guys, do you agree? So if a company is redeeming a debenture for a price which is slightly higher than what you actually receive, don't you think that should also be added to the cost? That's an added cost because you are paying them higher amount. So that element is being brought in here. Similarly, if a company is paying them slightly lesser amount, don't you think that that marginal benefit should be adjusted against the cost? So the cost can be slightly lower also than we actually thought because the redemption value is less. What I'm trying to explain you is think from both perspectives, how the redemption value differential with the net proceeds can actually impact my cost here. Everyone, guys? Durga, I think, I guess everyone else is able to see. Can you please also check at your end with the screen issue? Please just have a double check. Okay. Yes, Karthik. Karthik, I think this is simultaneously when you mentioned exactly at that point, I was saying the same thing. That when you're needing to pay that amount, when needing to pay them back, we are actually taking that differential. Absolutely correct. So, Anu, what we are talking about here is that let's take an example. Let's say you issued a debenture for 100, but the redemption value is 105. So, Anu, in this case, do you agree that I'm paying more, so this additional 5 should also be added to my cost? So what I'm doing is I'm incorporating that additional 5 over the remaining life of the debenture. That's the concept here. Right? I hope everyone okay. Now, in the denominator, we are looking at an average of redemption value plus net proceeds. Aditi, I think I just saw your point. I hope this is clear now with the last example. I just took an example. So when Anu was asking about the same, I had taken an example of 100 and 105. So that 5 is actually added to the cost. Yeah. Now, look at the denominator here. We are looking at average redemption value and net proceeds. Average of the redemption value and net proceeds. Why is that? Because across the life of the debentures, your invested value or the money you received versus money you paid, we are looking at an average amount because we are taking that differential into the picture in terms of cost to bring into apple versus apple comparison. We are looking at an average of redemption value and net proceeds in the denominator. So this is something which is important for you guys to understand, that we are just incorporating that differential into the cost. Now, only hypothetically, if I talk about that, let's say as per the tax laws, my discount or premium also becomes tax deductible. In that case, I can take the 1 minus t outside the main formula. See, why we are discussing this is when I'm looking at redemption value and net proceeds, it could be with respect to the premium or discount. It could be with respect to the premium or discount. Is everyone okay? So I think a couple of questions which are coming in from a perspective of the redemption value and the net proceeds. Let me take another formula for everyone. Give me a second. Okay, so let's see one more time and let me know if now it is clear to all of you. So let's take an example that a particular debenture, let's say this is again at 8% debenture with 100 par value was issued at 105. Let me take a different amount, sorry. I don't want you guys to confuse with the previous example though. So let's say it was issued at 110. Now, and this is with a maturity of 5 years. So guys, generally, when the debentures are redeemed at maturity, so this is today, we are standing here and we are looking at 1, 2, 3, 4, and 5. So after 5 years, if I'm talking about the entire maturity of this debenture will be more or less redeemed at 100 rupees at the par value. But when we redeem it prior to the maturity, it could be a different amount as well, depending on the market price. But at the maturity, we will be more or less redeeming it at 100 rupees. Now, my point here is, if I am talking about the cost here, as of today, year 0, do you guys agree with me that one part of the cost is 8% into 100? That's the interest part. But other part of the cost is also that I received 110, whereas I will be paying them only 100. So it's a 10 kind of a gain situation, which makes me slightly happy. But how will I incorporate that into my cost? So now that means when I'm looking at my interest, that is 8%, this benefit which I am getting due to the premium will be offset against the cost. So if there is a premium, my effective cost is going slightly down, because what I'm doing here is I'm doing I into 1 minus T plus I'm looking at redemption value minus net proceeds upon N. That means if I'm looking at my numerator, here, what's happening in the numerator? This RV minus NP is actually a negative number in my examples. I'm looking at 100 minus 110. So that means my interest is actually getting lower than 8%, or my cost of debt will be effectively lower than 8% in this case, in this example. There could be vice versa also. If I am issuing something at discount, whereas I am repaying them the entire amount, that is an additional cost. Guys, I hope this is clear to everyone. I think I took a couple of examples, should be okay now, all of you. Question from Namrata, why we divide by number of years? Because that's where that spread is incorporated, right? Namrata, because if I'm talking about like 3 years, 5 years, 7 years, the entire tenure over which that debenture or that capital is being utilized by us, interest is for every year, right? Interest is also every year. That's per annum. And that's fine. Okay, so now let's look at this illustration, guys. Why will a person buy a debenture for 100? Okay, Siddharth is a very interesting question. Why will a person buy a debenture for 110 when he will receive only 100 amount? Okay, Siddharth, it's a very, very classic question. I can add a little bit of an information, probably you will be okay then. Let us say, and I told you when I started this, for the issue price, there are two things: market rate versus stated rate. In our case, the stated rate was how much? 8%. Let us say in the market, the rate of interest for a similar debenture is 6%. Siddharth, is it okay? Then company would issue the debentures at premium because they are paying a higher interest rate, and probably an educated investor would also don't mind. They're paying a higher interest rate. That is the reason. It could be an opposite scenario though. Let's say a market rate of return is 10.5% and you are only issuing 8%. Then probably a debenture might be issued at, let's say, rupees 92 at a discount, because you are paying less interest. No one would come to you. So this differential between market rate and stated rate is very important for us. Although you don't need to worry about that, they will more or less be giving you all the information you need. This is so that you guys understand the logic and the concepts. Aditi says, why you say that if debentures redeem before 5 years? Okay, Aditi, if I'm redeeming before the maturity, I would be redeeming at the value prevailing, right? But if I'm actually redeeming towards the end of the life of the bond, as per the indenture, I am supposed to pay back the face value. That's the logic. Okay, great. So guys, let's move on. Now, I think a couple of students are a little ahead of us. They have already given an answer of the illustration on the right hand side. So let's look at the illustration here. A company issued 10,000 10% debentures of rupees 100 each at par on 1st April 2012 to be matured on 1st April 22. So the tenure is 10 years in this case. Now, company wants to know the cost of its existing debt. Now, look at this. Please, guys, we are talking about existing debt. On the 1st April 2017, that's 5 years later, when the market price is 80 rupees. Now, in this case, guys, the net proceeds will be the current market price. Everyone okay? So let me give a couple of chances to other students as well. I think I can see unanimous response coming in from students, 11 point something. Let's see if other students want to answer this. So I'm just kind of giving you another 30-40 seconds. In the meantime, I'm just looking at a couple of queries also. Anu says, basically, we can say that the premium price is helpful for reducing the burden of the interest. I would say, Anu, I would just frame it slightly different, that premium is offered for actually, or rather premium is charged for actually giving them a higher rate of interest, right? Look at that way. It's your security. You're charging a premium because you're offering more. Okay. So guys, I agree with everyone here. You guys, all of you who said 11.67% looks absolutely good. Because see, in this case, my tax rate is 35%. So I into 1 minus T is 6.5 here. And then I am talking about, and my redemption value is 100 here, because at the maturity, as I said, I will be paying the face value. My current market price is 80. So if I would have redeemed them today, I would have probably talking about 80 here. But since I will be redeeming them at 100, that's 20 is not so good for me. But what I'm trying to do here is I'm also holding on to that capital. I'm utilizing that funds in my business for another 5 years. I think look at that way. So that 20 divided by remaining life, not the original life, guys. Original life was 10 years, but I'm talking about 2017. So 20 divided by 5. So that 4 also going in to my interest net of tax, which is 10.5 upon average. That is 90, guys. So 11.67. That's simply amazing by all of you. Smita says the reason why we average, Smita, because this is, so we are talking about apple to apple comparison, right? We are using the differential within the cost. And that is why we are using an average, that is average of amount we received and average of amount we pay. I hope that's better now. Good job, guys. So it was good, 11.67. Sudhanshu, I hope you got it. And I think just 1 or 2 students had a different answer, but I hope everyone is okay now. Okay, so moving ahead, very important aspect, guys, when we are looking at another method when we talk about cost of redeemable debentures. Just the other method when we talk about approximation method, but now we need to understand what is a yield to maturity. Now, yield to maturity, the term itself talks about a very interesting phrase, right? Yield to maturity, that till the maturity, what will be the yield coming in from a particular debt? And we are talking about cost. We are talking about from company perspective. Now, the simple way to calculate the yield to maturity is compute that rate, please listen to me, compute that rate at which the current price of the debenture is equal to the present value of all future cash outflows or inflows. So think from a company perspective. In a company perspective, if I'm issuing a debenture today, for me, the today's inflow versus the present value of the future cash outflows, because future cash outflows will be interest and principal for me. Hiral, yes, we will be talking about some MCQs in between. Okay, we'll be talking about some MCQs in between. Okay, so guys, I was talking about YTM, yield to maturity. So think from a company perspective that yes, today we are looking at what amount we are receiving in terms of the debentures when we are issuing it versus what I will be paying in future. That is interest and the principal. So we need to understand that yes, how we calculate cost of redeemable debentures using a YTM, because for us that is a real cost, isn't it? We are just squaring out all even Stevens that, in year zero, we are looking at, in case of a new debenture, net proceeds, in case of existing debenture, current market price. But the future outflows for certain are partly made up of interest and partly made up of your principal. So that means basically we have a simple work cut out that we need to know, okay, we need to calculate we need to know the cash flows, and we just need to calculate the net present value. I hope everyone here is aware of how do we calculate net present value, although we will be discussing at depth the same in our investment decisions and capital budgeting sessions as well. But still, anyone who is not sure, when we are talking about some cash flows here, so let's say this is our year zero, and here we are talking about 5 years later. So today we are having an issue or net proceeds, and then we will be talking about interest every year. And the last year, there will be also a principal. Now, all of these are outflows. And I am looking at that rate. If I discount all these amounts, and how do we discount it? We are talking about multiplying with depending on how many years we are discounting for. And for the fifth year, it will be 1 upon 1 plus r to the power 5. So we have to calculate the present value of all the future values, add them up, and then we have to see, okay, whether that is equal to my net proceeds. So we need to calculate that rate, the rate at which the inflows equal the outflows, guys. And that is what we will be understanding now. And we will be spending some time on this internal rate of return concept, IRR, a lot in the capital budgeting as well. So don't even worry about this. If you are, let's say, 9 out of 10 clear, you need a 10 out of 10 clarity, don't even worry. We will be talking about this concept again and again. Okay, so that's important. So in this case, the issue is, how do we calculate that rate directly? So what we'll do is like kind of a guesswork. What we'll do is kind of a guesswork. And when I say guesswork, guys, we are looking at probably two different rates. We will be calculating the NPVs of cash flows using two different discount rates. Now, what we need to understand is, I will be telling you a formula which you will be using in IRR in investment decisions again. You need one positive and NPV, and you need a negative NPV. And when I'm talking about discounting these cash flows at two random rates, let's say I'm talking about two random rates, and I am telling you that, okay, hey guys, I've taken these two rates. One is giving me a positive NPV and one is giving me a negative NPV. Can I ask you guys a mathematical question? The mathematical question is, when I took two random rates, the higher rate would that have given me a positive NPV or a negative NPV? NPV is, again, as I explained you, your initial flows minus the present value of the future cash flows. That's your NPV. So my question is, if I'm taking two random rates, the higher rate, would that have given me a positive NPV or a negative NPV? This is a mathematical question, guys. Think logically. Okay. I got responses from Sundhanshu and Aditi. Both of them are telling me, okay, let me just wait for few more responses and let's see if everyone is giving me a common answer. Amazing, guys. I'm absolutely touched. You're looking at Sudhanshu, Aditi, Siddharth, Karthik, Tanvi, Ban Reddy, and Smita. All of you, absolutely amazing, guys. Everyone is giving me a uniform answer that it will be a negative NPV with higher rate. Just couple of responses now I am receiving slightly different. So those of you are telling me a positive, please try to understand when I'm discounting, I'm multiplying with this any amount with 1 upon 1 plus R, right? Think about mathematical version. If my rate of interest is increasing, this entire amount will actually go down. You're increasing the denominator, mind you. If you increase the denominator, your resulting amount will be less. So a higher rate would give you a negative NPV and a lower rate will give you a higher NPV. That's absolutely amazing. That's good. And if you know that concept, and I'm sure all of you now realize that, yes, that's logical. So in that case, definitely you will understand this very easily, guys. So let me explain this concept with the help of this example here. So company issued 10,000 10% debentures of rupees 100 each on 1st April 2013 to be matured 5 years later. Company wants to know the current cost of its existing debt and the market price of the debentures is 80. Compute the cost of existing debentures assuming 35% tax rate. Guys, if the question is silent, you go for YTM because that's more practical method. Always a little bit of a time consuming, but that's more practical. Look at the factor that you had so many questions when I was talking about the redemption value, net proceeds, why we are doing this, why we are doing that. But when you're looking at this concept, okay, cost of capital is that rate at which my initial cash flows are equal to the future present value of the future cash flows. You guys are all together, right? Everyone is in sync. So this seems to be a more logical approach. So let's understand, we talk about how we calculate here. Okay, what are my cash flows? My cash flows, one is a current market price. It's not a existing debt here. Current market price, because the requirement here is cost of existing debentures, that is 80. My redemption value is my future amount. At the maturity, I will be paying 100. And then my interest, net of tax, is 6.5. So these are my relevant cash flows, which I need to know. And we need to calculate the NPVs at two discount rates. You need to know this formula of IRR, guys. This is really, really important. This is, if you know this, some part of your capital budgeting investment decisions unit also is covered here. So IRR is equal to lower rate plus, we are looking at NPV at lower rate upon the difference between the two NPVs, NPV at lower and NPV at higher. And I hope everyone agreed with me when I'm looking, guys. Okay, let me ask this question again. I'm writing something here. NPV at lower rate is higher than NPV at higher rate. Does everyone agree with me? Does everyone agree with me here? Yes or no? NPV at lower rate is greater than NPV at higher rate. So let's say agree or disagree. Yes, all of you, everyone agreeing with me. Absolutely correct, guys. So that means, and when I said when I said that, okay, one has to be a positive NPV and one has to be a negative NPV, that means this denominator will always look like something like this: positive number minus negative number. And that minus and negative number will collide with each other and become a positive. I hope everyone understands. The denominator will actually be a minus minus always. As I said, we need a one positive NPV and one negative NPV. In the denominator, more or less, it will be always addition, because NPV at lower rate minus NPV at higher rate, and mind you, the NPV at higher rate would be a negative NPV. And this is something which is very interesting, that once we know this, we'll never go wrong. Right? So let's see what we are trying to do here. So we took two random rates here. So let's say first we took 10%. So my 10% rate, at discounting at 10%, my initial price is 80 here. Okay, great. Now, from year 1 to 5, if I want to calculate the discounting factors, 1 plus R, 1 plus R square, similarly 1 plus R to the power 5, we are looking at something called present value annuity factor here, which comes out to be 3.791. So from an investor perspective, investor will be getting 6.5 or some kind of an interest. 6.5 is net of tax. Investor will be getting some interest amount, and company will have to pay that interest, for which the tax is deductible. That's okay. Now the present value of these future payments versus today's market price is netted off at 10%, which gives me 6.74 as an NPV. Present value, the 80 amount is not discounted. 1 to 5 years, it's all interest, but the principal amount will be 1 upon 1.10 to the power 5. That's 0.621. So I can see a positive NPV here. Hiral says, okay, there are a couple of interesting questions, guys. Let me take them one by one. I see a question from Hiral. Why it is called discount rate? It is not mentioned in the question. We are assuming, Hiral, we are assuming two rates. Next question actually relates to this. Aditi says, how do you take random rates? What if both negative or vice versa? Aditi, I think your question is a classic query right now at this point of time, when I'm already explaining you that, okay, at 10%, I got a positive NPV 6.74. Aditi, you are okay with that point? Aditi, I hope this is okay. 6.74 is positive NPV. Now, if I know that I got a positive NPV with higher, with one rate, should I take the next rate as a higher or a lower? That will answer your question. If I got a positive NPV with one rate, the other rate has to be higher. Now, this is what you guys agreed with me. This is what you guys agreed. So you have to so first you assume only one rate. Okay. I think all of your questions will be resolved now. First you assume any one random rate. And then you can accordingly decide whether next one should be higher or lower. Guys, is it okay now? Thumbs up. All are with me now? After assuming the first rate, can second rate be assumed in a more comfortable manner? And how much higher and how much lower, of course, depends on what is like. In this case, 6.74 is a very, very slightly marginal number. So probably you could have taken 12, 13% as well. But I have just taken a random 15%. Siddharth, thanks a lot. Great. So Aditi, I hope your doubt is also taken care of. So at 15%, I'm getting a minus 8.51. And when I plot this into this formula, I'm getting a 12.21 IRR. So that means the conclusion is at 12.21, at 12.21%, my current cash flow is equal to the present value of the future cash flows. And that's the cost of debt. That's the cost of debt using yield to maturity, guys. Guys, everyone okay here? Is this example? Okay, Prabhas says how to assume the rate. Okay, Prabhas, that's okay. Don't even worry about that. If you're saying that your assumption rate is not matching with the study materials assumption, that's okay. See, the point is if let's say the answer given is 12.28 and based on assumptions, your answer is 12.31, marginal differences based on the assumptions, that's absolutely fine. No one is going to penalize for that, right? I know what you're talking about. Let's say you would have taken 8%, study material is taking 10%, that's okay. But you can take your second rate based on the 8%, right? At least that part you can do. Yeah, great, guys. Now, one more thing I would like to talk about quickly in terms of this long-term debt is your value of a bond, guys. Now, we talked about this a lot when we were, I think some of you, I think Aditi or Neha, some of you were asking me about premium or discount, and I was explaining you that why a premium, why a discount, the difference in the interest rate, and so on. I have a question from Sudhanshu. Sudhanshu says at year 0, discounting factor is 1. Sudhanshu, I would like to cross question you. Will today's amount carry any interest element? You don't need to discount today's amount. No? Today is the present value. Today's amount is the present value, right? So at year 0, it is, you don't need to discount that. That's already as present value, right? I hope it is clear now. So now we want to calculate a value of a bond which could be repaid in installments. So there are different types of debentures and bonds. Like classic example, something which is like, we also call it as serially numbered bonds, which are repaid in installments. Now, in this case, when we are talking about repayment and installments, think about any loan also. Forget about bond, think about any loan. We know that when we start repaying loan, of course, there are EMIs, there is interest element, there is a principal element. But as far as the principal is concerned, my outstanding principal will be reduced as the annual payments are made. Is that clear, guys? And once my outstanding amount gets reduced, my future interest amounts is no longer same. Okay, couple of questions. From Hiral, how the discount rate and cost of debt is 10%, why equal? Hiral, are you talking about the previous question here? That 10% was an assumption. This 10% is stated rate. What you guys are looking at is, guys, first of all, I think couple of queries is, you need to understand, correlate my discussion on the very first page when I was talking about the basic terminology. I hope you understand we talk about the interest rate, which is also specifically stated in the indenture. So this 10% doesn't mean the cost. For cost, we are actually computing. 10% is a stated interest rate. As I always, tell that, okay, cost is not necessarily this 10% only. We talk about the formulas other than the YTM. The cost was adjusted with the differences of premium and discount as well. Hiral, I hope it is clear. Yes, Pooja. Anu, I would not say a different answer. I would say, negligibly different is absolutely acceptable. Ideally, it will be very, very close to each other. Someone is getting 12.24, someone is getting 12.29. So I might say that, okay, calculation may bring up such marginal differences, but that is not a different cost of capital altogether. Okay. Okay, guys. So coming back to the discussion I was doing, I was talking about the bond which is repaid in installments. And we need to calculate the value of that bond. The logic remains the same. How do we calculate the value? Present value. We discount the future payments. We discount the future payments, guys. So as the outstanding principal will be paid every year, annually, my interest will be reduced because my balance outstanding is reduced. And what I'm trying to say here is, in this case, my future cash flows will not be uniform. Interest will be lesser and lesser, although the principal prepayment or whatever the amount of bond I am repaying might be same, but interest is definitely being lesser every year. Yep. So let's try to understand this concept also with the help of an example. M&M is proposing to sell a 5-year bond of 5,000 at 8% rate of interest per annum. The bond amount will be amortized equally over its life. Calculate the bond's present value for an investor if he expects minimum rate of 6%. Now, the important part is the bond amount will be amortized equally over its life. So we're talking about 5 years. So if this is the case, we look at the outstanding amount 5,000 at the beginning, and accordingly the 8% interest is 400. However, with every year repayment, you can see my outstanding amount is getting reduced, and accordingly my interest amount is also being reduced. So in the total outflow, the principal is constant or uniform, but my interest is definitely reducing. So the total outflow is not same. What we are looking at is total uneven outflows. And since in this case, what we are talking about is that the expectation, so they gave you the cost of capital here in this case. We are talking about investor is expecting a minimum rate of 6%. So we are using that factor for discounting it, and we are calculating the value of the bond. And when we say value of the bond, what does this mean? That probably if this bond is issued today, it will be issued at a premium, guys. Yes or no? What do you think? We are talking about a discounting factor at 6%. But don't you think that was expected? Don't you think that was expected, guys? Is it a surprise? Let me ask this way. Isha, I will explain that also. Guys, are you guys surprised to see this amount at a premium value? I am not surprised. I want to see your response. Okay. Aditi, are you saying that you are surprised the premium amount? What about others? What were you expecting in the valuation? Okay, let us forget about the solutioning side. Let us go back on the question here. From the question itself, you should be able to say, tell that, okay, whether it could be a premium or a discount here, guys, to be very honest. What was the investor expectation? 6%. Can we say that was a market rate? And what is the company paying? 8%. Yes or no? And if you're paying higher than the market, you generally have a premium case or not? Hence proved. And I'm sure all of your discussions which we have been doing for last 1 hour actually boils down to this point. That yes, when there is a difference between the stated rate of interest and the market rate of interest, then it will be a discount or a premium. Guys, I hope everyone is clear now. Neha says slightly confusing. Neha, what is confusing in this? What we are doing here is we are calculating the present value using the cost of capital. I told you what is cost of capital. We are not calculating the cost of capital in this scenario. We are calculating the value of the bond. But for calculating the value, we are using the cost of capital, which is seen from a perspective of expectation of the investor. Remember my first slide for the evening, guys. Cost of capital is not seen from a perspective of what you are paying, but It is seen from a perspective of what investor is expecting. So we are using that 6% rate for discounting as a cost of capital. But I am paying 8% interest. So my interest payout is 8%. However, the amount is reduced because every year there is a principal amount being paid. But I am not surprised that I'm arriving at something which is more than 5,000. I'm not surprised because my the rate at which I'm paying the interest is higher than the cost of or the market rate. I would say that. Okay, Siddharth, thanks for confirming. Okay, Pooja, again, Pooja and Smitha, you guys are talking about the same query. So let me explain once again. Yes, we are talking about value of bond here. What should be the issue price today? Let's talk about a better terminology. Issue price. At what price this could be an issue today? So both of you are clear that if I am paying you higher than the market rate, I will be charging a premium, right? This is okay. I will be charging a premium. Now, we just did in our previous discussion that in yield to maturity, what we are looking at is initial funding versus future payments. In this case, we are not calculating NPV, mind you. We are just calculating the present value. We are just calculating the present value here of all the future payments. So basically, we are calculating the initial price. In the YTM, we were given the initial price. Please understand here. In the YTM, we were given the initial price. We were given the future payments. We had to calculate a rate at which both were equal. In this case, you are given the rate. You are given the future value. But what you need to calculate is the present value. That means now I can very well say, those of you are not clear on this concept, that if my issue price is 5262, if my issue price is or the value of the bond is 5262 and rest of the information is same, and if I had actually to calculate the cost of debt using YTM, it has to come to 6%. Guys, I hope this makes you clear at least. Hiral says, rate is higher, the amount is negative or less. Yes, Hiral, that is okay. Hiral, that was okay. Okay, Raghavan says, what is the purpose of using discount factor? Raghavan, I hope now it is clear because we are calculating the value at which I will be issuing. I have basically linked the two discussions, YTM and the valuation of the bond. So guys, we can look at other way around that let's say they were not giving you 6%. They gave you the issue price, 5262. They gave you the other information that this will be repaid in installments. This is the interest payout. And you had to calculate that interest rate at which will be the cost of debt. And using YTM, you would have got around 6%. But instead, what they are telling you is they're giving you the 6%. In the question itself, they're giving you what, the value, they're asking you what will be the value of the bond if the investor is expecting a minimum rate of 6%. Guys, I hope each one of you agree that minimum rate of 6% is nothing but cost of debt is given to you. Na? This cost of debt is given to you. 6%. Guys, is it okay? And then they are also giving you the stated rate. What you are just calculating is, by discounting at cost of debt, they are calculating the valuation of the bond. Aditi, it's up to you how you ever want to say. I want you guys to just understand this. Great. Awesome, guys. Thanks for confirming. Okay, we are just talking about just last point in terms of the debt, and then we'll have a break, guys. Now, this is something with respect to cost of convertible debentures. Now, in terms of the cost of convertible debentures, the holders have option to either get the debentures redeemed into the cash or to some specified number of shares. Now we need to understand, okay, convertible debentures. That means apart from a normal debenture, these debentures have a specific feature that yes, they can be converted. Now converted could be into equity shares or into some cash. Now the point is, when we are looking at conversion, we are in effect settling our liability, isn't it? And hence, this is nothing but very similar to cost of redeemable debentures. Cost of redeemable debentures, because you're redeeming that. So what? For cash or equity shares. This is nothing but convertible debentures. Treat them like a redeemable shares. Only thing you need to know is any rational investor will always choose what is beneficial for them. If I am giving you some amount in cash or I am giving you some shares for your debentures, you will immediately look the share price and calculate, okay, how much is this worth, and compare with the other option of cash, isn't it? And I'm sure you guys will always go for a higher value, whatever gives you the higher return. Am I correct? I'm sure each one is preparing for chartered accountancy. I think that much you guys are clear, right? You guys know what's best for you. Okay, whichever option is beneficial, you will opt for that. Whether cash is more or the number of shares is more. Right. So, but the point is here that the formula remains the same. The redemption value based on the same formula talked about. Right. So the illustration here reflects using the same formula here. Companies issuing 10,000, 15% convertible debentures. Maturity period is 5 years, and debentures are having an option to convert into the equity shares of 1:10, and they're giving you the current price as well. Current price of the shares, and historically the growth of the shares are 5%. Compute the cost of debentures assuming a 35% tax rate. Now in this case, the only factor you need to calculate is a redemption price. Now they are telling you the current price of the equity is, what is that? 12. Now after 5 years, what will happen? Today's share price is 12. They're asking you that this conversion or this redemption, we will be talking about at the 5th year. What will be the value? They are telling you historically, based on the growth rates, this will be growing at the rate of 5%. But you're talking about 1:10. So this is the price of one share. One share. So that will be multiplied by 10, which will be 153 something. So you're getting a redemption value of 153, and rest of the game knows. Everyone knows here what we need to do. We have a redemption value. We have the net proceeds or the current market price. In this case, we're talking about the net proceeds, and we do the amortization. So that same formula, I into 1 minus T, differential of redemption value and net proceeds spread over the life of the bond, and you calculate the debt. So I think that this is basically nothing but a application of cost of debt, where you have a convertible debentures. In convertible debentures, because they are convertible, we can call it them as a redeemable debentures. The only thing you need to be careful of is if they give you in the question that either there will be an option of this much cash, or there is an option of these number of shares, please do a comparison whether cash is higher or the value of the equity shares is higher. So you always pick the higher amount and then calculate the cost of debt, guys. Always use the higher amount. Rational investor. Every rational investor will go for what is best for them. Okay. So couple of discussion points. Gihani says in the exam, can we write a note? Differences may rise due to discounting. Gihani, that's okay. If you want to say that, okay, see, the point is you would rather state a valid assumption that, okay, we are taking this as a first rate and we are using the other rate because of so-and-so or a positive or a negative NPV. That's absolutely fine. Don't worry. Anu says the discounting factor is a minimum expectation or RO. Okay, Anu, for discounting, so I would say this is the other way around. When we will be using these cost of capital concepts in investment decisions, we will be learning this automatically that when we are discounting the cash flows, we are using the cost of capital or the hurdle rate. This is what we will be anyways doing in capital budgeting decisions. Aditi says, what will happen if the growth rate changes in the future? Aditi, very, very good question. In future, accordingly, the value of the bond could change if the growth rate changes or the value of the bond. So this is the value of the bond at this point of time, not future. But in future, if they have to calculate the value of the bond again, and then the share price is something else, then the cost of debt could be different. And that is why I want to correlate your query to Anu's query, that whenever you would be using this cost of capital in any for any purpose, you also need to understand, okay, you guys want to clear the exam with good marks, that's one purpose definitely, but you also need to have a practical insight into why these cost of capital will be used, when these cost of capital will be used, more or less when you will be taking investment decisions. So if you have some kind of a capital investment proposals after 3 years, that time you will probably compute your cost of capital at that point, your weighted average cost of capital at that point. And then if the factors changed, you would take the factors known at that point. Aditi, I hope that is absolutely clear. So this is at a particular point of time when we are calculating. Okay, great guys. So let's do one thing here. Let's take, I think I have a good solid, I would say interactive discussion till now. Let's take a 10 minutes break and continue our discussion. We'll move to the cost of preference shares after we are back. So let's take a quick break. Be back guys. We'll see you shortly. Hey folks, welcome back. I hope everyone had a much awaited and wanted break after a lot of interaction. And during the break, I was looking at some queries here. So I had one from Pooja, which says, if you're talking about the changes in the value of the shares in future, what will that have an impact? Will that increase my cost of capital? That's a very interesting, Pooja. But if you remember another query before the break where I said that we are calculating the cost at that particular point of time. Of course, if the value changes in future and we have to calculate the cost again, it will have an impact. And more or less, when you're talking about higher value of the shares, the redemption value will increase because the company is giving you more in return. And hence, it will definitely increase the cost. But yes, mathematical calculation, you have to validate. But a very, very valid point over there. Okay, guys. So let's continue our discussion. Next element in our capital structure is preference shares. I hope we all understand the preference shares theoretical part, though, how different it would be from a debt, of course, from a liability to an equity perspective. But they generally do not carry the voting rights. All that, having said that done, what I need to ask you, everyone, is that like we pay interest to the debenture holders, we pay dividend to the preference shares, but can anyone give me a very important difference between the two costs? One, interest that I'm paying to the debentures, and two, the dividend I would be paying on the preference shares. Is there any difference between the two types of payments? Let's see. What are your responses? Is there any difference when we look at from a cost perspective? One, with interest on debentures, and two, dividend on preference shares. Siddharth has a question. You did not understand the calculation method in present value, how and what to apply the discount factor. Siddharth, you're talking about the value of the bond, right? Siddharth, you're talking about the value of the bond. No, in that case, it was given in the question itself. Na? We are talking about the expectation of the investor, 6%. So we will, when we are calculating the value, we'll be using the cost of debt for discounting it. We'll always use that. And the discounting methodology is same. Right? Okay, so I'm coming back to the answers given by many students here. Karthik says tax benefit is not available. Banreddy says dividend paid only if the profits are available. But I think mostly all the students, including Tanvi, Prabhas, Pooja, Smitha, even Khushi, all of you are talking about same language here. No tax reduction. That's absolutely perfect. See, the logic is when we are paying dividend on the preference shares, of course we understand that dividend is not mandatory. That's fine. But we also understand that yes, they get priority over equity shareholders. But at the end of the day, it's dividend. And when it's dividend, it's appropriation of profits. And when we say it's appropriation of profits, it's not tax deductible. It's not tax deductible. That's the big difference. And that is why I would say that from a company perspective, that cost of preference shares would be slightly higher than the cost of the debt because the dividend is not tax deductible here. But from the student's perspective, the good news is that that the formula is resembling, right? So not much overload from a work perspective. So if you look at the formula here, cost of redeemable preference shares, it's like preference dividends plus redemption value minus net proceeds upon N, and denominator is not alien to you. So it's very, very similar formula what you guys discussed in debentures, isn't it? The only thing is 1 minus T is not there. That's it. Everything remains same. Now, as I said that, the net proceed factor also, keeps it discussion along the same point. Are we talking about the new issue or are we talking about the existing issue? So if it's a new issue, it would result in any kind of flotation cost. That's what it means, right? Issue price minus any issue expenses. But if it is not given, then we don't have a choice. Then we have to assume it to be a current market price. That's it. So those are the basic things. We are anyways doing the same way as we did for the debentures also. But let's see our example on the right hand side for Zenith Limited. So they're giving us 1,010% preference shares of 100 each at 96. So you're issuing it at 96. The company proposes to redeem the preference shares at the end of 10th year from the date of issue. We have to calculate the cost of preference share, guys. I'm giving you 1 minute. Can you do a quick mathematics here? Apply the same formula. Tell me what should be the cost of preference share here. So I believe they have given us the dividend number or the dividend rate, 10%. Do we have a redemption value? That's what the key point is. Do we have the net proceeds? Net proceeds definitely we have, 96. But do we have the redemption value with us? I told you something, right? Redemption value at the maturity, we are talking about the face value. So I'm already seeing some answers. Let's see what others have to tell me. Hitesh has given me an answer. What about others? Hero says preference dividend is fixed. That's absolutely correct. The only thing is that, yes, it's not mandatory. It is a liability when it is declared. But that's not our perspective right now. We are talking about from a cost of capital directive. Okay, so different answers flowing towards this one. I'm assuming that many of students are still doing the calculations. So around 4 or 5 students are giving me 10.61, Hitesh, Smita. But there are other students who are giving me slightly different answer as well. Karthik, not sure if you want to check your calculations one more time. Mind you, there is no tax. Okay, so guys, please ensure in a comprehensive question where you have different types of components of capital, they will be giving you tax rate also. Please do not do 1 minus t here. Please do not do that. Right? I think I would like to go with the majority here. Majority of you are giving me 10.61. So see, what is my preference dividend here? 10% into 100, that's 10. And I told you my redemption value will be 100 in this case at maturity. Net proceeds is given to us is 96. So that difference of 4 is spread across the remaining life. That's the 10 years. And then the denominator is the average here. So it's coming out to be 10.61%. So I think a couple of answers which were like slightly different. I hope you got it where you went wrong. I think a couple of students who gave me 14 point something. So I think there is a common error over there. And Prabhas, I hope all well. So I think 10.61 would be the answer. Okay, please check your respective calculations. Yeah. Now, in terms of cost of irredeemable preference shares, now this is more like it. As I said, in terms of debentures, that the redeemable debentures are like more like it. I would say for preference shares, it's irredeemable preference shares more like it. We're talking about the capital till perpetuity, right? So it's like a calculation of an annuity till perpetuity, or I would say one amount that you have to pay year on year. If of course if it is declared. So if there is an irredeemable preference shares, classic equity, the formula is pretty straightforward. That's your preference dividend upon the net proceeds in case of issue of the preference shares. See, the idea is, in this case, we are actually talking about that, yes, is the preference dividend is my cost? Yes, it is. But in the case of issue of the preference shares, there could be a flotation cost as well, issue expenses as well. That has to be reduced, and that will raise my cost of preference shares slightly than it should be, or than the preference dividend rate, because my denominator will be lesser. So let's see this illustration here. If Synergy is issuing the preferred stock at 100 per share with a stated dividend of 12% with a flotation cost of 2%, what will be the cost of preference share in this case, guys? Let's see, what do you have to say? Very straightforward. What we just need to understand is that I am paying 12% dividend. So my numerator is preference dividend, 12% into 100, 12. But my denominator is not necessarily 100 here. I have incurred 2% flotation cost as well. And hence, my denominator will be 98. And you can see that my cost of preference share is slightly more than 12%. And I think when I'm seeing the responses, Hitesh, Karthik, Aditi, Sudhanshu, everyone is bang on here. It's pretty straightforward and very logical as well. No, so Karthik, when we're talking about from a flotation cost perspective, here it's not a regular payment, right? It's a net proceeds, it's a one-time payment, right? So add the interest when we're talking about tax benefit. I'm sure that you are thinking from a perspective of that we give tax benefit to interest, because that was a cost, that was the interest you will be paying every time. But when you're talking about flotation cost, that's just one-time hit. We are adjusting that in the net proceeds rather than having it adjusted in numerator. So, okay, yeah, Smita, Akash Neel, Gihani, and Siddhant, all good answers. Okay, guys, now we move on to the most important aspect of cost of capital. Of course, every aspect is an important one, guys, and many students have been talking to me in the past about the way to any shortcut to success, guys. Do you know any shortcut to success? I know only 3 shortcuts. I'm sure many of you would be interested to know, right? 3 shortcuts to success: hard work, discipline, and dedication. Nothing else. Practice, practice, and practice. I believe in old age saying, practice makes men perfect. I just slightly altered that. Practice makes men and women both perfect, right? So all of you need to just keep your focus on, and I'm sure your hard work will definitely pay off, right? So moving on to cost of equity share capital. Okay, before I do that, Aditi had a question. Flotation cost, if given in percentage, always calculate on fair value. Yes, Aditi. Yes. Or they give in an absolute amount. Okay. Specifically an exception, if they give you that, this X percentage on the issue price, then you are, stuck over there, because issue price is not 100. I hope you got my point. So be careful of the language. Generally it would be, but there could be some specifications, as I gave an example. Okay, guys. So now we talk about cost of equity share capital. And cost of equity share capital, and overall, when we talk about the cost of, weighted average cost of capital, all these concepts will be very heavily tested. Generally you would be seeing a question where they will be giving you different elements, and you're calculating the individual cost and also the cost of weighted average. But if there are questions on a individual component in isolation, this is an area which is frequently tested. So cost of equity share capital, and I'm sure we all know in terms of the equity shareholders that, from a company perspective, it's the most expensive, that, right? Less risky, high cost. Why is that? Because you're not bound to pay them back. There is no liability as such. But why it is a higher cost? Because the expectations of the investors are higher. They are investing in you, right? So they could have invested those funds over, somewhere else. And that's why it is very, very important that we understand that, yes, it is definitely, a higher cost attached to them. Now, there are different methods. Okay, just give me a second. Let me check if there are any questions in the meantime. Yeah, that's fine. So there are few methods to calculate the cost of equity share capital. And I think all of the methods will be covered. There are few methods more important than others. I will talk about them separately. So one is dividend price. earnings price, growth approach, realized yield approach, and capital asset pricing. So if you ask me, your growth model and the capital asset pricing model is very, very, very important. So make sure that you guys have your hands on, you guys have your practice on various past year questions on these. Right, so let's talk about these one by one. So the first method we are talking about here is dividend price approach. As the name suggests, it is nothing but very similar to what we discussed in terms of the preference shares also. So here we are working on a very, very big assumption, which may, I would say, sound a little weird to most of you. And that's why I say that, it's not a very, very common or a famous method here. But yes, what we need to understand is that, you need to understand that there are various methods to calculate. So in the dividend price approach, what we are assuming is that the dividend per share is expected to remain constant forever. Mind you, we saw a similar formula in preference shares, but there was a stated rate of dividend. But in case of equity, that is not applicable, right? So if I'm looking at KE, cost of equity, is D upon P0, where D is my expected dividend. So the idea is that the dividend is not common, right? It's not constant. This is not constant. I hope everyone with me on this. And when we say that it is not constant, we really need to be cognizant of the fact that yes, that is why probably this method is not very common. It's not very common because you cannot expect same dividend forever, and that's why it is not common. But still, okay, we need to know this. One is earnings price approach. That is the second method here. Earnings price approach. Now, as the name suggests, based on the company's earnings, the investor probably is having some kind of an expectations based on the earnings price approach. That's the name suggests, and probably that's how the price builds up. Earnings upon price. But the idea is that, okay, we are talking about the cost of equity. That means we are not even worried about whether a dividend is paid or not. Same way we can say that, okay, in the dividend price approach, what about the amount that was not distributed? So there are issues in these models which may not make it so practicable. So when we're looking at that, yes, it is based on the earnings. Here the assumption is that the earning per share will remain constant forever. Can earning per share remain constant, guys? Can earning per share remain constant? I don't think so. So even here also you can critically look at this method that yes, it seems to be based on dividend price approach, but the idea is that you're just trying to nullify one part that, okay, dividend may not be constant, but whether earnings can be. And what you're trying to see is that, okay, dividends may not be constant. Let's do earnings. But how about earnings? Even earnings can fluctuate. Having said that, be familiar about these methods, guys. So cost of equity using dividend price approach is your dividend upon P0. And cost of equity is earnings upon P, right? So we need to understand that, yes, both the methods can be critically argued upon, and that's why these are not very, very common. The other methods which I was talking about, growth approach and capital asset pricing model, those are also having some assumptions. I'm not saying that those are like more or less robust methods of calculating cost of equity, but in comparison, they are better methods of calculating the cost of equity. But let's do one thing. Let's quickly look at a question on earnings price approach. Right? So what is your earnings price approach talking about? E upon P. A firm is considering an expenditure of 60 lakhs for expanding its operations. They're giving you some information here. Number of existing equity shares is 10 lakhs. Market value of existing share is 60. Net earnings is 90 lakhs. Compute the cost of existing share capital and of the new equity, assuming that the shares will be issued at 52 rupees with an issue price of 2 per share. Aditi says investor earnings will not depend on dividend. Aditi, you are absolutely correct. From an investor side, definitely their earnings is dividend. But when we are looking at the dividend price approach, the drawback was the dividend may not be constant, right? And we're just moving on to an earnings price approach to nullify that effect that dividend may not be constant. But the problem was actually bigger here. How come the earnings can be constant? Aditi, I hope that's sets your query. Okay, so we are talking about this. Let's see who want to give me an answer. So here we are talking about two sub questions. One is cost of existing equity and new equity. First, I will be inviting the answers for existing equity here. So there are two parts. One is existing and one is the new equity. So I request everyone to give me an answer for the cost of equity in case of an existing share capital using the earnings price approach. Should be easy, I guess. Hitesh, are you sure? Just be careful of the decimals. Give an answer in terms of percentage. So a firm is considering 60 lakhs expenditure. So I'm just reading some information. Some of you are finding it less zoomed out. So number of existing shares is 10 lakhs. Market value of existing share is 60 and net earnings is 90 lakhs. Karthi says what market price should be considered? A rational person, why he will issue 60 at 52. Okay, so Karthik, that for that you need to understand the various factors for which the market value of a share and a book value of share may be different. Performance, growth perspectives, overvaluation, undervaluation. There are a lot of factors which comes into the picture. A valid question though. Okay, so most of the answers are coming for me is I think two answers for option number A. I'm getting 15% and 16.66%. 16.66%. Okay, guys, they've given us net earnings is 90 lakhs, and we had number of existing shares is 10 lakhs. So, guys, what is this giving us? EPS 9 is my EPS, earning per share, and market value of existing share is 60. So 9 upon 60. I believe that it would be 0.15 or 15%, guys. Some of you got 16.66. I'm not sure how. I'm talking about the existing. Whereas for the new equity, the denominator will change. So the new equity, the denominator will change from 60 to 52 minus 2. So that's 18%. So correct answer is 15 and 18%, guys. I hope everyone with me on this now. Those of you who are slightly here and there. All okay, guys? Okay. So now the first of the two important methods, the growth approach, or we also call it as a Gordon model. Right? So in this case, as I said, even here, there are certain assumptions, but probably we also need to understand, being a finance student, that all the models have to be built on certain assumptions, right? We cannot mix up financial models and economics, which said ceteris paribus. Ceteris paribus anyways said all other things being constant. Even the economic laws are using that concept, right? And when we're talking about financial models, even here also, we are talking about, yes, there are certain assumptions need to be made, but probably some models can have more rational assumptions than others. I would say that. So look at the assumptions here. Now, this model assumes that dividend growth remains constant and earnings, dividend, and equity share will grow at the same rate. I can see a larger, or I would say slight step ahead as compared to the previous methods. I am not saying dividend being constant. I am neither saying earnings being constant. I am accepting that there is a growth in dividend. That's fine. I'm also accepting the earnings will also have a growth. However, there is a catch. If I am a critic of this model, I would say that, okay, dividend, earning, and equity share price all at the same growth rate. So that would be a critical factor in newly issued shares. That is net of any flotation cost. So this is something we discussed earlier also. So either we are using the current market price, but for newly issued shares, we are looking at net of any flotation cost. So that means probably we are looking at, yes, existing versus new. And my question is the next one. We are looking at plus G. So KE is equal to D1 upon P0 plus G. Mind you, this is not in the denominator. So what I'm trying to say here is D1 upon P0 plus G. But my question to all of you is, why are we adding G here? Why are we adding G, which is like a constant growth rate of dividend? Why we are adding a growth rate, guys? Can anyone answer that, please? Shouldn't D1 upon P0 would have served the purpose? Shouldn't D1 upon P0 would have served the purpose? Why we are adding G? So let's see the responses. So the question is why we are adding G here. Logic. Okay, let's see who gives the answer first. Wow. Hiril says because dividend is fluctuating. Prabhas says because we assume growth in overall market price too. Aditi says dividend grow yearly. Khushi says we need to incur more cost in proportion to growth rate. Guys, I think let me repeat my question. I'm saying KE, if I would have stopped at D1 upon P0, cost of equity, I think you guys understood earlier that yes, what investor is expecting, right? Cost is what investor is expecting. Investor is expecting dividend. So D1 upon P0. Why we are adding G? Shouldn't so like in the earlier example, earlier model, look at the dividend price approach. It was only D upon P0. What my question is here, why we are adding G here? Okay, you guys are giving me a uniform answer that that because the dividend is growing. Try to understand differently here. And let me break the ice while more and more students are responding to this. Even Karthik is saying the same because growth is in respect of all the factors. That is why G is added. Tanvi says growth rate is also going to be the cost. Tanvi, you are very, very close to what I am expecting. Very, very close. Why is that? Guys, is the entire profit distributed as a dividend? No, right? Some amount will be reinvested in the company. So this G is taking care of the retained profit as well. Guys, I hope the logic is now clear to everyone. We are not only talking about cost of equity in terms of what is distributed, but also talking about what is not being distributed. That is why we are adding G. And we will also see how G is calculated, if not given to us. Mostly G will be given to us, but what does G comprise of? Definitely I gave you a partial answer that it is basically growth with respect to the retained earnings. That is the amount which is not yet distributed as a dividend. So amount not distributed as a dividend. So there are two portions. D1 upon P0 takes care of what is distributed, and G takes care of something which is not distributed. Okay, so that's one piece. Now let's take an example of this illustration, how to apply this formula. Company has paid a dividend of 10 per share last year, and it is expected to grow 10% next year. Calculate the cost of equity if the market price of share is 220, guys. I think a couple of students already given the answer already. Wow. Hiral, thanks for acknowledging that. I think if you're saying me that, yes, you are now understanding the relationship of equity and retained earnings, it's absolutely amazing because you're absolutely on the right track. Aditi says, as not distributed is also growing. Yes, Aditi, absolutely. The growth in the undistributed earnings, right? So guys, what's the answer? I think I'm getting 15% unanimously. So we are just talking about the key part is to understand the D1. This is my D1, D0 into 1 plus G. So 11 upon 220, that's one part. And then 10% is my growth. So 15% is the answer. Guys, the beauty of this formula is you're talking about this Gordon approach. Everyone, guys, good answers, guys. All of you are correct here. I think Siddhant, Prabhas, Smita, Sudhanshu, I think one or two answers were slightly different. I think probably you guys messed up with the points, decimal points, I guess. Gihani, I guess that's the mistake at your end. I'm sure you guys you can check that later on. The beauty of this formula is when I'm saying that KE is equal to D1 upon P0 plus G, can I also write something of this sort? Wait a second. Do you agree with me? KE is equal to D1 upon P0 plus G. Okay, let me just write it again and slightly bigger. And what I need you guys is to tell me if it is correct or not. So we are looking at Gordon's model and we are looking at KE is equal to D1 upon P0 plus G. What I'm writing here is at the bottom, P0 is D1 upon KE minus G. Do you guys agree with me? Yes or no? So what I'm showing you is the beauty of this model is not only helping us in calculating cost of equity, but also helping us to calculate the price of the share, just like we did the value of the bond earlier. You guys agree? Hitesh agrees with me. Those of you who are slightly double checking that whether to agree with me or not, you can take your time, but probably you can evaluate with one particular step in between. And hence we arrive at this. So guys, this is the beauty of this model, right? So it serves the dual purpose. It's the same model talking about two different languages, depending on what you have and what you need. So moving on, as I said, in most of the questions, they will be giving you G, but we need to understand how do we calculate growth rate, how the growth rate is actually arrived, right? So there are a couple of methods here. One is an average method, which is on your screens right now, which says that we are looking at an average like over the number of years. We are looking at a growth rate upon D0 upon Dn minus 1. Don't worry, they're not expecting you to calculate this. They're not expecting you to calculate this. This is just for your information purposes. That you need to know that, okay, how the current dividend versus the dividend n years ago, how that has grown over the number of years. And this is basically coming in from the future value table, right? So don't even worry about the calculation part. Just try to understand, okay, one way is average method. Okay, I know the dividend in 2021 versus what was there in 2011. And accordingly, I just need to calculate the rate at which would growth. But imagine my assumption was the growth rate has to be same. So that makes my life easier here, because I'm not looking at a growth rate which keeps on changing. I'm talking about the constant growth rate. That helps me here. Whereas another method which talks about of growth rate itself is the Gordon's growth model, where what we are looking at is that we are defining G as a component of B and R, and this is what I was trying to explain you why G was added. This method is actually backing up that logic. That B refers to my earnings retention ratio. I actually told you that not all the earnings are distributed as a dividend. There is some amount is being retained in the business, and we are multiplying that with the rate of return on funds invested. So I think Aditi and a couple of more students at that time told me when I was explaining that logic that G is with respect to the return on the amount reinvested. And I think now you guys got it. Everyone okay, guys? Yes, Karthik. I was basically talking about the other way around to calculate the pricing of the share. Absolutely correct. So guys, now everyone with me with the Gordon's growth model, we are looking at that. Yes, some amounts of retained earnings are reinvested in the business, and hence the investment will also grow with the rate of return. All okay, guys? So I think this actually backs our logic of why that G was added. Anyways, the same family, right? Gordon model. They will explain their own model. My way is to just clear the logics for you. Okay, so let me just go back few slides and remind you of different methods. We looked at a dividend price approach. We looked at earnings price approach. We talked about growth approach. Now we are left with two: the realized yield and capital asset pricing. Realized yield and capital asset pricing. So let's move on to realized yield approach. Now, name has something in it, realized yield. Okay, that means we are looking at something which had happened in the past, probably to repeat in future. What we are saying here is expected return is based on average rate of return realized in the past. But we know we had criticized the earnings price approach for probably the same reason. Right? So again, the idea is that the risk the companies or the organizations are governed with, or the expectation of the shareholders, they could be different. That is why this is again an impractical approach. However, since we are talking about this, let's look at an example from your materials. How can we calculate the cost of equity using the realized yield approach? So let's look at the facts given to us. Years 1, 2, 3, 4, 5. Dividend per share for all the 5 years. Price per share at the beginning. Now, we need to understand what is the realized yield across all the last 4 years. Now, I need to understand from you all, from an investor perspective, when you invest in equity shares, what is yield for you? Please tell me. Is it the dividend? I think by now you know the answer though. But I want to make it a little bit more technical. Is it only the dividend that you are looking at or something else? Aditi says, meaning of the yield. Aditi, yield is like the benefit till date. They say that, Yield to maturity, like we told, yield to maturity, till maturity, what was the return that particular security was giving? Yield is the return, and that's what I'm asking you guys. Whether as an investor, you guys are only interested in dividend or something else also. This is what I want to know. Karthik says increase the market price and dividend. Amazing, Karthik. Absolutely, I roger with him. So see, the point is here, what I'm trying to say here is that you as an investor are not only looking at the amount which company is paying as a dividend, but also looking at whether my investment is growing in capital value also as well. See, you guys together as a group agreed with me that yes, there is some amount of earnings that is being retained in the business. That means that will also grow. And even if we ignore that, okay, book value and market value would be different. Even if we, for a second, we ignore that factor, we all agree that the share value is increasing because the equity, the amount of retained earnings are reinvested, and they also grow. So that means you are looking as an investor, two things. One is dividend and one is increase in the share price. That's what you're looking at. So yearly return, probably in the form of dividends, and also the capital appreciation. Right? Absolutely amazing, guys. So I can see answers with, from Pooja, Aditi, Bandredi, and Aditi, and everyone, right? Tanvi also. So I think all are perfect. Now let's try to calculate this realized yield across last 4 years. Now what has happened in year one? What has happened at the end of the year one? Mind you, these prices per share are given at the beginning. We are now seeing what has happened at the end of the year one. There is a dividend of 1, guys. And there is a movement of share from 9 to 9.75. That means total return is how much? 9.75 plus 1, 10.75. So your investment of 9 is now looking at 10.75. Am I correct? Because you got 1 in dividend and your value of the share is also increased. Yes or no? So 10.75 upon 9, which is like 1.1944. Guys, all okay here? Is the calculation okay with everyone? And we can see the second year also. Okay, so give me a second. So look at the second year. In the second year also, dividend is 1, but my investment is from 9.75, it has grown to 11.5. So that means it is 1 plus 11.5 upon 9.75. So it's 1.2871. So every year there has been a movement. So we are looking at dividend plus ending value upon the beginning value. And we are looking at the yield for all the 4 years. And using the geometric mean, we are just using one yield, what we have got. That is 1.15 minus 1, that is 15%. Now, don't worry about the mathematical calculation part, though. Just understand the concept here. What we are looking at is that, okay, on an average, how my investment has grown in the past, both in terms of dividend and also in terms of the capital appreciation. And we are arriving at 15% accordingly. But I would say this will be criticized because of the same reason that how can we say that the expected returns are based on the returns which were realized in the past? Can we really say that? I don't think so. And that's why it is not so practical approach. Okay, so the last model, which is a very important model for cost of equity. This is a capital asset pricing model. I told you 2 models, very heavily tested. That is your Gordon's model, growth model, and your capital asset pricing model. Now, to explain this model to you, I need to make you understand a couple of types of risks that investor generally considers while making an investment decision. One is called as a diversifiable and one is called as a non-diversifiable. Now, I'm sure many of you would have elder siblings or parents who would be making some investment in stock market, guys. But do they, or rather, when you would have participated in any of the discussions, do they invest only in one particular company or multiple, guys? What do you think? Is it good to invest the entire money, entire funds available for investment in one company, or should we, put some money in different companies? What do you think? Aditi says, although we see share prices, but why it is important to increase? Okay, Aditi, I'm just a little bit twisting your query. I'm sure that's what you wanted to ask is that I'm sure what you're trying to ask is that there are listed prices, but why the focus is always on, the price should go on. I think answer to your query would be there is a difference between book value and market value. First of all, you understand that. However, from a shareholder perspective and for company perspective, both it's a kind of a win-win situation. They would prefer, as an investor, they would prefer that the value goes up, but not for the reasons which are, I would say not so technical or related to the company growth. So more the share valuation is linked to the company related factors, company growth factors, better it is for the organization. Right. So just because a share price is increasing in the market is exactly the same proportion the company is doing good may not be always true. And I think that's what you wanted to clarify. Okay, so responses from many students, multiple companies. Great. So I think everyone agrees with me that yes, we need to diversify our portfolio. So that means if I am finding a risk only by investing in one company, can we say that that risk is a diversifiable risk because that can be covered, that can be eliminated by investing in other companies, guys? Yes or no? We can diversify this risk by investing in other companies. So let's say if I have some funds I want to invest in, let's say L&T. I feel that, okay, probably I would like to put something in IT and something in the financial sector as well. I'm actually diversifying my portfolio here. So it's called a diversifiable portfolio. However, I would also like to add one thing, that if something happens with one specific company or something happens with one specific company internally, that may not be impacting the other companies, right? And that is why we call this diversifiable risk also as unsystematic risk, because this doesn't relate to the entire system. Guys, are you with me? So one type of risk is your diversifiable or unsystematic risk, which is the company specific risk, can be covered by easily diversifying your portfolio. Whereas any risk which relates to the entire market factors, which can impact the entire system, which may not be covered by diversifying your portfolio, is called as a non-diversifiable or a market-specific risk, because that could impact the entire industry. Now that is related to some macro factors like government policies, inflation, global factors. So these can change the scenario of the entire market. So two types of risk, guys. Diversifiable is unsystematic. Non-diversifiable is the systematic one. Because that is why it is non-diversifiable, because it can impact the system. The way to remember this. Now, for our purposes, we are considering the systematic factor. Why? Because diversifiable can be easily covered, right? So the CAPM, the capital asset pricing model, considers the systematic risk factor. And we all understand as a rational finance student that if we are willing to take a higher risk, probably it is only because we absolutely want to take or get a higher return. Otherwise, why would a rational investor willing to take a higher risk? You would always go high risk, high return, right? So the formula for cost of equity using CAPM is a risk-free rate. Now I will explain each and every component of this. Risk-free rate plus beta multiplied by market rate minus risk-free rate. What are we talking about? Okay. Let us try to correlate these two understandings. First of all, I need a confirmation with everyone. All are okay? High risk, high return, direct proportion. More risk you want to take, more return will you get. Is it okay with everyone? I'm assuming. Also, can there be some securities where there is no risk at all? There is no risk at all. Government securities, government investment schemes. Can we say that there, because there is no risk, the return will be also less? Return will also be less, low risk, low return. So is everyone okay with the RF here? RF is a risk-free rate of return. So one component of cost of equity is RF. Now, as I progress from the no risk securities to either a low risk or a high risk, that means I am moving from government securities to, let's say, private institutions, private companies or public companies or companies in which the government doesn't have any stake. And do you agree with me that compared to the government securities, those companies will have a higher risk? You guys agree with me? If you leave the blanket of government securities and you go to invest in the market, you will always carry some additional risk. These are not backed by government. They are not having any government stakeholders. And if they are having higher risk, you need higher return. That's what you agreed with me. You can't back out now. If they're having the higher risk, you will have the higher return. And that is why the market rate will always be higher than risk-free rate. So what we are doing now here is cost of a particular equity is RF plus RM minus RF. Now understand this. RM minus RF is a premium over and above the risk-free. Like how much additional return would I be able to get if I leave this risk-free security and go for any other corporate security? Guys, logical? I'm talking about a higher premium. How much I am going to do, how much extra I want. That is multiplied by beta. Beta represents my systematic risk, because that is okay. You might wonder with me that you might wonder that why we are multiplying this with with beta. RM minus RF. We are already adding a premium to my risk-free. Guys, let us say that if beta was not there, let's assume that if beta was not there, how my formula would have looked like. This RF and RF would have been cancelled, and you say, like, what the hell? My cost of equity is market rate of return. No, it cannot be. What about the risk that can change the entire market? What about the risk that can change the system? That is why we multiply that risk premium with that magnitude of beta. So if there is a risk which can change the entire system, we will multiply that with the risk premium and add to the risk-free rate to arrive at cost of equity. Hence, we have to multiply this with beta so that we are having more logical formula. Guys, everyone okay with understanding of CAPM formula? Each and every component. Beta represents the systematic risk. But please try to appreciate one factor. In the questions for your purposes, be careful. Sometimes they can give you RF and they can give you market risk premium. Please don't subtract RF from that, because market risk premium is already RM minus RF. Please don't subtract again. Don't do that mistake. Be careful of this term. This is risk premium. Please be careful. Right? So we're talking about a small illustration. The cost of equity of IHG Limited risk-free rate is 8%, beta is 1.5, and return on market portfolio is 12. So simple formula: 8 plus the premium of 4 multiplied by the beta. So we're arriving at cost of capital here of 14% for us. 14%. Guys, everyone okay here? CAPM formula fits in for everyone? Okay, let me see. Prabhas says, how is beta calculated? Prabhas, not so there are equity analysts, there are team of experts, they have statistical models, data driven from various factors beyond controls, and they kind of compute, and they keep those factors keep on changing. Prabhas, I hope you understand that, right? Tanvi, the same question. Tanvi, I was answering Prabhas' query, which is same as yours. Okay. Okay, so Karthik says, so cost will be comprising the constant, low risk, but the constant cost and the risk factor part. Absolutely, Karthik, wonderfully portrayed. So Karthik, you're absolutely spot on. So what I'm saying is that base expectation plus the premium adjusted with the systematic risk. Base return plus premium adjusted with the systematic risk. That's what your cost of capital as per the CAPM. Okay, so guys, one more thing. Just give me a few more minutes, guys. We'll wrap up shortly. I would like to show you something very interesting here. What I was talking about is that if you see on the right hand side, there is a diagram which talks about government bonds, corporate bonds, and preference shares, equity shares. Very worth noting is that as you go from government bonds to equity shares, your risk increases. Do you see, guys? Very logical. So this is a very, very interesting example of how this kind of risk grows, and why we are multiplying that with beta. I'm sure everyone is okay here. And there is something. Here says again, explain G equal to B into R. So here we talked about of G is equal to B into R, because B was your amount of retained and R was return. So if you had invested something in the business, that money would also grow now, because that is reinvested in the business. Okay. Coming back to this slide, security market line. This is so basically what we need to understand is security market line is that line over which at any point KE is equal to RF plus RM minus RF into beta. So basically security market line is actually depicting the cost of capital using CAPM model at various risk factors of beta. Higher the risk, higher the cost. Guys, do you agree? Higher the beta, higher the cost of equity? Yes or no? Very logical. Higher the beta, higher the cost of equity. All of you with me? Tell me, guys. So let's see the response. Yeah. So everyone with me, right? So we can see this upward slope, and then there is a risk-free rate. So that is why I wanted to just have you a quick glance that, depending on which particular security you are going to from government bonds, your risk premium can be larger and larger, and accordingly cost of equity can be higher. This required return is nothing but your cost of equity. Make sense, everyone? Now, okay, Karthik says, is it right to say that the reason behind equity being most expensive and riskiest is the security that dependent on most costly factor, which is like market price. I think Karthik, again, I would like to add upon the points you mentioned is that think from a basics also. There is no obligation from a company perspective. At the same, on the hindsight, investor had a higher expectations in terms of opportunity cost. Right? Companies under had no obligation. And that's why equity is expensive as a combination, or also there is no tax benefits. They may have seen a lower risk from an organization perspective, but a higher cost because from an investor perspective. They would always have a plan B. But what you are also adding is that, we are talking about market price, that I would say as a resulting factor. I would say that is a resulting factor anyhow. Okay, Aditi says KE also is calculated from risk other than earning or growth. So that's what capital asset pricing model says. And Aditi, I think in hindsight, do you believe that when we said D1 upon P0 plus G, we talked about a calculation of growth, although we had some assumptions, but of course, those assumptions or those rate would have incorporated the risk factors anyhow. And so the only difference is in CAPM, the risk is pretty much transparently coming on the formula phase, right? And I think, Aditi, that's what you said, right? Only this formula is which is bringing risk element. Okay, so guys, that is absolutely amazing. I'm sure that everyone had a wonderful evening here. I would like to give a pause right now. Whatever we have covered, I want everyone to go back, read, practice some questions. We have a lot of practice coming up on 23rd. That's where we'll be resuming our session from cost of retained earnings, guys. So we'll be in the first half of the next session, we'll be talking about cost of retained earnings and also weighted average cost of capital. And the second half, we'll be doing some practice. So I request everyone to please kindly cover whatever we have done. In fact, read the subsequent sections also in terms of the retained earnings. And I think now that everyone with that growth formula, everyone here is also understood that the retained earnings cost is very important. I can just give you a little bit of while leaving the session today, I can just give you a little additional note that think while you read at home, while you read at cost of retained earnings, think about this. Whether I have to raise an additional capital or not. Just giving you a hint here. If a company doesn't have to, raise an additional capital, you would save on flotation cost. Guys, everyone okay? If the company doesn't have to raise additional capital, you will save on flotation cost. In that case, cost of retained earnings will be equal to cost of equity. But where the company is raising additional capital, cost of equity will be higher because of the flotation cost. I just want to end the session with this note. You guys need to read. We will be covering this again on 23rd. Then we'll have the part 2 of this particular topic. I just want to have a quick check on any of the queries here. Yes, you guys need to have some memorization of the formulas, guys. Karthik, yes, I'm trying to create some suspense, but I'm also expecting you guys to come prepared, do some reading so that we have more interaction and fun. So great, guys. I think I had an amazing session. I'm sure you guys are all excited. I think with the group here, with the kind of responses, almost like 400 plus responses I can see, it was amazing, guys. All of you are purely a bunch of dedicated students here, and I'm sure you will embark your journey with success. And keep up the good work, guys. Keep up your reading and practice. I'm sure we'll have equally more fun in coming sessions. So we'll wrap up remaining part of the cost of capital on 23rd, guys. So take care till then and continue the hard work. Please remember those words that, hard work, discipline, and dedication. That's what the success mantra for all of you. Best of luck. Have a good evening, guys. Good night. Take care.